Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And yes, the background is different. We have a house guest for the next several weeks. Instead of talking right next to the room they are sleeping in, I decided to be a good host and talk downstairs. So it is what it is. I'm still here for you daily, and it's Friday. So we got Stephen Dow from Velocity Mortgage. How you doing, sir?
I'm doing fantastic. Good morning. I was gonna ask about that. Actually, I didn't know if you were in the doghouse.
I had to sleep on
something
the
happened,
couch.
and so yeah, you're in the man cave or something. I don't know. So.
No. We have a house guest that we've invited from the East Coast. So no, just trying to be a good host, and more importantly, keep this thing rocking and rolling. Right, 5 videos a day, every day for a couple of years is not a trend I want to stop. So I'll just talk from my living room.
It's a good change.
Yeah,
no, it's a good change for the background. It's nice.
There you go. Well, hey, Stephen, one of the things I want to talk about, and again, the reason I have you on the channel is because you're one of the experts. You're obviously filling the non-QM space, which is going to be very important, I think, going forward. And one of the reasons is because of what Matt, the mortgage guy, and I talked about in one of our videos this week. And that is lending the box, you will, to get a yes answer is changing. And there's actually been some proposals. Matt was talking about a proposal on July 12th that if
with FHA.
With FHA that really could take it out of the market. So obviously we are not talking about owner ox. That's not where you play. We're talking to investors in single families, 1 through 4s, apartments, mixed use, all of those. But right now it's going to get harder. The rates may be very appealing, but to spend 60 days in a maybe state and then to lose a deal because you got a no answer. Sometimes it's easier to go a different route. So, I'm curious, does Velocity Mortgage as a non-QM space, do you guys pay attention to what FHA and conventional are doing for investors, and that allows you to work around them? Do you guys look there? Or you're like, not really competition? Don't play?
I don't know. I mean, that's more of a question for upper management as far as strategy wise for the company. But I would imagine to some degree, but it's mainly, I think, for profitability and
of course,
how, and also the need of the market, because if we can find a particular, underserved space that we can still adjust whatever our guidelines are to some degree, and we can afford the risk, then that's what we've been doing. So as time progressed with this company, I've seen, our product line expand, evolve. So again, with the move of the market and what's been needed. So, so we can get into all those details, but definitely.
Yeah. And I almost forgot, we got to do that marketing thing first, so you and I don't get in trouble. Why don't you do that now?
Perfect. So again, I do work for Velocity Mortgage Capital, although all the ideas and topics discussed on this channel are that of my own. So we can get it started whenever you are.
Yeah. So again, this is your opinion. When I look at what Velocity Mortgage has done, and I've poked around, right? You've been on the channel now for 3 or 4 months. And what I do see is I see a company that is evolving to the market, right? So what I expect them to do, if investor loans get harder, right? Lower debt to income, higher credit scores, more down. Yeah, the rate's great, but if you can't get a yes answer, it just doesn't matter, right? It just doesn't matter. I've seen Velocity Mortgage be really, really flexible. And again, we'll probably talk about this program a couple of times in our 3 series, but you've just released a 30-year product that allows the borrower, given the environment we're in, to choose an interest-only period, even though it's still 30-year amortized. You can select, I think it's up to 10 years. Did you tell me that?
Right.
So again, that's Velocity changing to the market, which is really cool.
Exactly. With so many different life-changing events that are totally out of control, global epidemic, new variants coming up, out every day. It's going to be very useful to have a little bit of payment relief when you need to, when you don't know when it's going to happen. So with up to 10 years of your first 10 years of a 30-year fixed rate, which gives you the security of a rate being at least fixed for 30 years, so that you don't have to look to refinance in an inflationary environment, 6 to 24 months from now, if you do decide to refinance maybe into a bridge loan, so that's where the comparison is you get the best of both worlds. But yes, that's where we're kind of evolving with the market. And
then the other thing that just non-QM vendors, which Velocity Mortgage is one of them, you get speed and certainty, right? Which you don't get with a conventional or an FHA backed loan, right? They have their systems, their boxes, and they could change at any time. What is the average timeline for a non-QM loan today? Is it Is it sub 30 days or just over, or what's going on?
I mean, it depends on, it's really all dependent upon the appraisal, depending upon the property type and location.
Makes
We'll
sense.
kind of,
So appraisal's the long pole.
that's the long pole, because we're a direct wholesale lender and with very little, paperwork, because again, we're stated income, no
Right.
taxes, no case, no W-2. We pull credit initially. If we know that, then we move on to the next steps before we start spending any money. But once we pass that, then it's just pretty much finding out what the appraised value comes in at.
Okay.
Once that comes in the door, we do the review of it. Takes typically less than 48 hours if nothing changes on or any corrections needed on the report. And typically from the time we receive the appraisal, which is about 2 to 3 weeks, depending upon the property type and area, to the time you're in docs, about 4 days.
Yeah. And the other thing I still, again, I've been doing this for 20 years plus now.
Right.
The other thing I scratch my head at is as a non-QM lender now, you're routinely giving fixed rate loans with a 6 on it. And some people are probably even getting like a 5.99 or something, which yeah, I mean, that's just crazy cheap money for a non-traditional bank. I mean, it just hurts my head to think about that.
Right. And again, with the flexibility, rates not too far off from conventional when you look at the actual payment and the cash flow, especially with that 10-year interest only option.
Yeah.
When you're doing the math between what the rate would be somewhere in the 5s versus maybe like 3.5, 3 and 5/8 on a fully amortized, it's not much difference in payment. But then now, if something should happen, new variant, new eviction moratorium gets extended, whatever the case is.
Yeah.
Now you need some sort of, bridge or parachute to kind of help you to that next, more stable situation. But that's where we come in.
Yeah. And again, it's speed and certainty for me. Again, I was just thinking about it the other day, knowing we were going to talk on Friday, right? Let's just assume I get a 6% loan with you. And let's assume I get a 4% loan. Again, I can't because I have too many units, but let's just assume that. But the 4% loan was a maybe, and it would take 60 days. And the environment for good or great deals today is still pretty hot.
Right.
I would hate to go through a conventional loan and get 45 days in, and for some reason the answer is no, that I can't undo or change.
Or the algorithm changed and now your approved eligible is now,
yeah, that's what Matt was talking about. It's just the debt to income is lowering and stuff like that. So one of the things I really advise investors to do, obviously, is if you can still get the bank money, get the bank money all day long, without question. And I expect you to tell people that when they call.
That's what
but if you're a maybe,
right,
you may have to run both routes, because
use this as a plan B. It's always good to have a plan B in place, because you never know.
Yeah, you never know. And then again, you do have the ability to really run different playbooks. And I think we're going to talk about this probably in episode 2 or 3. Right. A lot of investors are buying what I used to call junk, right? Non-perfect. And in today's environment, that's not where conventional lending wants to play, right? They're like, nope, doesn't pass the smell test. Right. But frankly, that's where the value is created, is in, slightly used or even distressed assets. And that's, again, where non-QM lenders play, right?
Definitely. Flexibility, not only in guidelines pertaining to, the borrower and their situation, but also in reference to the condition of the property. Yeah. Again, most conventional lenders don't offer any kind of fixer-up type financing.
Not today.
Yeah. And the quality of the property is also, of importance as well. So not to say that we take on, 100% junk. No. It's got like health or safety issues. We're going to obviously need those to be fixed. But, right. So.
Yeah. Again, you really are you're one of the critical partners. If you're looking to create a business out of this and really do, multiple deals a year, right? I think any investor needs to have a non-QM lender in their back pocket, meaning the relationship's a file open, so that they're ready to move forward if they get a deal. So I'm curious, the one rental at a time community, are they reaching out to you? Has it been quiet? Is it busy?
Oh no, it's been a kind of a mixture, just depending upon, I think, that week's show. Okay. It's funny. It's like out of sight, out of mind. If we don't do an episode, I still get residual, calls or emails, depending upon what video they clicked on. Yeah. So, but it's a wide range of either blanket loans, smaller markets, commercial property right now. I mean, these are like real specific loans that are in process right now.
Oh, that's cool.
We're just having some issues with appraisals, of course.
Yeah.
Again, that's usually the part that you have to rely on third-party performance, right? Whether it be the appraiser being able to get in contact with the, point of contact, to be able to let them into the property. That, I mean, really, it sounds so simple, but
yeah. No, it's yeah, appraisals are a long pole even in conventional stuff today. So I'm glad to hear it. I'm glad I'm glad, people are reaching out. So it's worth your time is what I hear you saying.
Oh, 100%, because again, I've got a multitude of people calling in, and I don't even get the loan because we're talking about, hey, have you gone through all of your resources for conventional financing first? And if they say no, then it's like you definitely need to contact them first. Matt, the mortgage guy, if you're out of California. So
absolutely, yeah, good. All right, well, I'm glad this is worth your time. It means we can keep talking every Friday. So if people want to reach out to you, how do you want them to do that?
Email is always the best. Again, if you can put it in the subject line, maybe ORAT, just the acronym for one rental at a time, makes it easy. And I'll kind of set up filters, because with the multitude of email responses after every show, plus the pipeline, and it's the end of the month going on at my company as well, I'm just getting bombarded with so many emails. So it definitely helps to kind of cipher them off so I can get you much quicker response. Yeah, so do me a favor, folks. If you're going to reach out to him, do put ORAT in the subject line, ORAAT. It's the acronym for one rental at a time, ORAT. Yes. So I appreciate that, Stephen. Thank you for your time. In episode 2, folks, we're going to talk about a tremendous lending program that is both fixed rate with options, as I call it. So, Stephen, thank you very much. I look forward to episode number 2. Likewise. Thanks, bud.